Good evening, everyone. Welcome to another edition of Market Pulse, trying to get all of my different names of podcasts straight. I've wanted to do this video for quite a while now. I used to do traditional markets all the time. I used to do them in the same videos along with Bitcoin. And I kind of stopped and I made them standalone. The problem was that I kind of didn't really keep them as standalone because I just got so busy. But because I am a traditional trader still, I need to keep up with economics. So I continue to try and do a conscious effort of bringing you guys um, the traditional market videos. Actually, I gotta give Mike, if you're with me, say something in the live chat. I want to make you an admin of my of the live chat, so we can have some moderation here for the day. Glad to see some people on. I got 330 people watching traditional markets. So that's awesome, guys. Now, of course, this is still an educational channel, so I'm still going to use the same indicators, the same ideas. So you do get to learn from it. That's how I started long before Bitcoin. All right. Let me see here. All right. I'm sure he'll say something eventually, so we can get some moderation going. Just tag me when you do. All right, let me go to screen share and we take it from there. All right. Same disclaimer applies. Please learn trading, guys. Everything on this page is completely free. A lot of these links are very, very useful. It's in educational tools. Learn trading on libertylifetrail.com. Now, what I'm going to focus on once again, even in traditional markets, is section 6. Add moderators. All right, now I'm set. Perfect. I am going to focus on section 6, my own version of it as well, and we take it from there. As you can see, I have a lot of links open, okay? And that's where we start. If my free stuff is not enough, please check out the consulting section of my website. And if you do want to see me in person and attend one of my seminars, here is the seminar section. A specific website for registration is eventually going to launch. Hopefully, some of you will get to register in a more modern way than just emailing me. Okay. All right, let's begin. I guess since I have the Bitcoin charts open, I'll briefly mention it, but it will not be the focus of this video. I will need another week to say anything about the weekly chart of Bitcoin unless we fall below 7,300, 7,200. Bitcoin stays neutral, and if we go above 9,900, I will then be bullish. So we got a long week. This was a huge rally at the close. Anyway, I'm not going to talk about Bitcoin. I talked about it this morning. Daily chart, nothing really changed. I mean, at best, Bitcoin has gone into neutral mode, but I still think the upside is somewhat limited. I'm not crazy optimistic yet, and I won't be until we're, pushing 11,000 or so. Not going to talk about the smaller time frames. Okay, so where do we begin? Do we begin with bonds or do we begin with stocks? Okay, that's the big question right now. It's going to be about the bonds, guys. The stock market is not important right now. It's really not. Normally, the stock market is the most important thing in all of economics. It's not right now. It's bonds. Okay. Now, when I was showing you this chart, as we were reaching the top, this was actually a 9. I don't know why it's not a 9 anymore. I think the data has changed. I need to find, different yield data to see what's going on. But this was a 9, so I was warned. I was warned that we're near the top of this mess. Okay. My code. Oh, that's not the latest code. Oh, so here's something else, right? So just before I went live, like I want to make this as clean as possible. I actually went into indicators and I did a search for like one moving average, and within 3 seconds I found one. I don't know if this is, where did it go? Here it is. I'm sure there are better ones. I'm sure some of my probably some of my my clients have written some, but I thought this was very simple. I like my 50. I like my 200. I like this one in blue. I like this one in Bitcoin orange. And you can choose not to make it exponential. And boom, you have 2 moving averages taking up 1 space. So useful. I like making them a little bit thicker. I'm actually adjusting my charts. I'm also going to add my own indicator here, use the defaults, and we're good to go. And here is the latest one with the correct settings. Okay. So when it came to the yields, oh, I like this. This is the daily yields. And you can see how we pulled into the golden cross. This is what I like to trade. I was always a big fan of trading the golden cross when price pulls into the cross. Okay. Yeah, I got to start putting my indicator first and MA second, just so that the bigger one is on top and the small one's at the bottom. Should probably throw volume in there too, but the volume, I don't know. I don't always care about volume. But this is what I want to see. I want to see a pull into the cross and then go up from there. So there goes your golden cross. I mean, the bond yields just took off. I want to put this on a weekly chart. I should have a standalone weekly. Yields are really important. Really important. So here are the yields bottoming. Whoa, the MACD went out of hand there. Here are the yields. Jeez. Is that all my data? Where's the rest of my data? I gotta get some good yield data. Yeah, so yields bottomed last year. This is the 10-year yield, guys. And here's the thing. I'm going to be watching yields because, and here's why yields are so important. Actually, we're going to talk about that in a minute. As far as the technical picture goes, oh, there's the weekly 9. There it is, right? So they're taking a little bit of a break, 1 to 4 candle correction, and then boom, we're going back up. So I'm expecting yields to pop to the upside. I've been saying this for a long time. This is the bond prices. This is the 10-year treasury note, the actual treasury note. Again, daily candles. Probably should look at weekly or monthly candles. Maybe next time. I don't have those charts ready. And bottomed on a 13. Very nice. Wall Street loves the traditional 13s. There's the aggressive. That was nice. This is the 9 that they came from. Okay. And now bond prices are going up, but I'm expecting this to be short-lived. I'm going to go to the weekly, and then maybe I can go to the monthly. Again, bottomed on a combo 13, also nice. So here's the bond prices, and you can see how the bond prices took a major hit. I even had a Fibonacci line here, and it pulled back up and stopped dead on the Fibonacci retracement, and then it went back down. So on a weekly chart, the moment you broke prior lows, you can see how the bond prices just tanked. All right, let me go to the monthly. Oh, yes, I have the data. So here's the monthly bond prices. And bond prices actually peaked in 2012. It had a secondary high in 2016, and now we're going down. So here's why it's important. And this is TLT, this is the ETF. So I'm expecting the ETF to go back down. It pulled into the moving average. Oh yeah, let me drop all of this. Maybe I'll put my, and I leave the defaults basically. Put the latest indicator up here. Yeah, I'm expecting it went into the moving average. I'm expecting this thing to just go way down. Okay, basically. Yeah, guys, throw some questions in there. I'll address the questions after. The questions better be traditional market questions. Actually, don't even give me the Bitcoin questions, man. You just put traditional market questions in there. I'll address them. Okay. Here's why bonds are important. Now, oh, wow. I'm not even getting a bunch of pictures. Okay. So I've been saving these pictures for like 3 weeks because I kept wanting to do this analysis. They're not going to be in any particular order, but what is this? Okay, I want to look at them one at a time in no particular order. There's a probability that the Fed is going to do 4 rate hikes this year. That's going to be crazy. Okay. So look, that's basically the consensus that the Fed is going to do 4 rate hikes. Now you can see how the Fed has already started raising the rates. The orange is the US dollar. So the US dollar has been dropping, but I don't think that has anything to do with the rates because I don't really see correlation there. Basically, what I've been saying for a long time, and I've been doing these traditional market videos for a long time, in that the Fed doesn't actually do anything. I mean, they buy bonds from the government, but they monetize the government, right? But the Fed raises rates when the market expects them to raise rates. It's so rare that the Fed does something unexpected. It did happen in 2015 and blew up my futures portfolio, unfortunately, but that's okay. So I had other trades that made up for that. Basically, the Fed is going to raise rates because the rates are rising. The free market is raising the rates. And the Fed is going to basically, the Fed's like a hamster on a wheel. When the market rates are rising, the Fed is going to raise its rates in order to keep up. The problem is bonds have been in a 40-year bull market. And as the yield starts to rise, the bond prices are going to fall. And money managers are going to start to sell the bonds. They're not going to sit in a losing investment. Therefore, they're going to have money to invest in something. And where is that money going to go? I believe is going to go into stocks. Okay. But everyone is expecting the Fed to raise rates 4 times this year. Okay. 4 times. All right. I got all these pictures. Let's see. That's the recent one. What else I got on the yield curve? Here we go. So here are all the crises that have been lowering the interest rate, okay, from the 20% that it hit, back in 1980. And here we go. Black Monday, SNL, Japan bubble, Mexico bubble.com, and the housing crisis, okay, the global financial crisis. Right. So there we go. And we're breaking above this trend line. Yields are rising, guys. Now that has huge implications on real estate as well. If the yield starts to rise, your mortgage is going to be a lot more expensive. And if your mortgage is going to be a lot more expensive, less people will be willing to buy a house. That means housing prices will probably go down, right? Lower yields help the housing market, okay? Even help with the recovery of the housing crash was low yields. If the yields start to rise, may not do very well for your real estate, all right? I'm actually considering selling my condo, especially if Bitcoin drops a lot. Man, I'm going to want to buy that dip. I'll need some cash, sell my condo. I still owe half my mortgage, but still, I'll rent for a little while. All right, let's close this one. What else we got on yields? Bond futures. So there you go. This is about a 15-year chart, and maybe a little less, like 12 years. And you can see how people are not very optimistic bonds. Look at this. I mean, that's just crazy. Investors like do not want to be holding bonds right now. The futures we're getting crushed. This is from when? Do I have a date on this? This is from March 2nd. This is already 2 weeks old. I'm not sure what it looks like today. Let me close that. All right, what else I got on bonds? I'm almost done with bonds, by the way. Nope, that's stocks. That's stocks. Gold. Yeah, we'll get to that later. Fed, more Fed. Chances the Fed outpacing its own rate projections. Wow. Yeah, so the Fed is going to raise rates. Now, the expectation is that they're actually going to raise rates tomorrow. Well, tomorrow or Wednesday, whenever they announce. I think it's a 2-day meeting, so Wednesday. And I'm expecting the rates to rise. I'm not going to have any bets on that because the Fed screwed me before, but that's the Wall Street expectation. Safe. And finally, almost done with rates. Here's a rate chart. Probability of 4 or more Fed rate hikes in 2018 is 35%. That's for 4 rate hikes. Okay. Yeah. So there you go. So you can go ahead and pause the video and read all that. Okay. All right. I think that was all my rate stuff. Yeah, I think so. Yep, that's the current stock market. All right, good. Got that out of the way. Let's talk about the stock market. I'm going to close these just so I can see what I'm doing here. That's the stock market. I want to close all this because next time I'm going to put on my indicator and stuff like that. This one already has them. All right. See, this is what happens when I don't do these for a long time. Indicators. My scripts. There we go. Boom. Here is the monthly chart of the S&P 500. Okay. Again, there is a big difference between my version of the indicator. These are coming from, like, I want to delete these things. Anyway, I'll delete them later. These arrows and stuff are coming from other time frames, which is why they're kind of annoying. Like they make no sense on this time frame, so I have to delete them. So that one makes sense on this time frame, right? So according to this indicator, I mean, there's no other metric I can use besides the time indicator. There just isn't, because we're dealing with all-time highs. And you can see on a monthly chart how many months in a row the S&P 500 went up, okay? The price flipped back here. Now notice how in both of these drops based on monthly candles, right? In both of these drops based on monthly candles back in 2015, the red 2 never went below a red 1. A red 2 never went below a red 1. There was never a short indication on a monthly chart of the S&P 500. However, the monthly chart with this indicator told you there was a bullish opportunity the moment a green 3 started trading above a green 2, right there. That took place in June of 2016 at a price of $2,100 in the S&P. It gave you a 9 for potential take profit, a 9 with the 13 the following candle. No one can fault you for taking a profit around a 9. That's what I would do. Take at least some profit. the market would then told you that you can get back into a buy and hold right there. In the 9 came on in December of 2016. You could have taken the holidays off, and then you come back into the market, even though you had a sequential 13 and a combo 13, but you had a 2 trading above a 1 after a 9. So that tells you that this 9 is setting off a countdown to 13, okay? And therefore, your entry back into the stock market is February 2017. And you can ride this all the way into a 9 that took place in September of 2017, okay? Now, this 9 looked nothing like a reversal candle. So you have no rush to get out, not to mention you're still working on the countdown because the combo 13 comes 2 months later in November, and the aggressive 13 and the sequential 13 come a month later in December. So even if you started taking some profit in this area, you once again had a green 1 and a green 2, with a green 2 trading above a green 1 the month of November 2017. So once again, you can go back into the market because there's another countdown coming from the second 9, and you can see that it was last month, it was on a 6, and this month will probably struggle to get you a 7. But we're still bullish here. Now, granted, last month was very volatile, and you probably got your stop loss hit, because one of the ways you want to set your stop losses, and I teach people this in my trading seminars, the month of January is what's known as an expanded range candle. And when you have an expanded range candle, you can set your stop loss just below the middle of that candle. And you could be out off of that stop loss, or you still have multiple reasons to stay bullish the S&P 500. I am not nervous about the S&P 500 at all, okay? I still think it's a bullish environment, all right? And my indicator is on a green 6, expecting a green 7 next month, and then an 8 and another 9, okay? So that's the long-term monthly view. I know this might be a long episode, guys. Anyway, so here's the worst thing that can happen to the stock market. Trump gets impeached. I don't care what you think about him firing everyone. I don't care what you think about his tariffs. I don't care what you think about his tax cuts, which are good for business and good for the stock market. It's all irrelevant. I will tell you that if this witch hunt to impeach Trump, which has been going on since before he took office, people have been trying to impeach Trump from becoming president from the day he started running for the election. Impeaching Trump will be the worst possible thing for the stock market. Like, I want to say that if Trump gets impeached, I would be shorting the stock market, but it will be too late. Basically, the day Trump gets impeached, the stock market will probably be down 20 to 30%. Well, like it actually won't trade because after the 1987 crash, there is a fail-safe in the stock market that if it's down 10%, trading is halted. I guarantee you that if Trump is going to get impeached, first of all, it would happen over the weekend, like all other major events always happen on the weekend, and the stock market would not open that Monday. Because if it was to open on that Monday, it would probably be down. We would probably break the record of the 1987 crash of 23% in one day. I can absolutely see that happening. Therefore, that's the only thing that would make me bearish the stock market is a Trump impeachment. And if that happens, you're screwed. You will not have a chance to get out. That's not how it works, okay? So this is what I don't understand. This, I mean, the Clinton impeachment was just bullshit, right? I mean, that was over, having sex with an intern. Anyway, But I gotta see how the market did back then. But I'm sure the market wasn't scared that Clinton was actually going to get impeached over sex. That's just ridiculous. But in Trump's case, it's different. Okay, and therefore, that's the only thing that can derail this market. The only thing. Okay, let's go to the weekly chart. Something a little more tradable. Okay, again, I'm going to delete all of these. I'm going to open up my indicator. And I'm also going to, actually, I should just be in favorites. I need to uncheck these two. I don't know why they're still in favorites. This is the one that I need. I don't need that either. And this guy. There we go, my moving averages. All right, let me actually set the moving averages. I don't want the 20, I don't want the 100. I want this in blue, I want it like that. I want this in orange, I want it like that. And I like simple. That's just my preference. Okay, look, the S&P 500 is still very much above the 50-week moving average. We came close, but we haven't even broken it, right? Look, the 50-day moving average has supported the S&P 500 since March 2016, sorry, and it doesn't scare me. Now, the weekly market topped on the aggressive 13, which is nice, a couple of days following a 9. So once again, yes, there was a green 2 trading above a green 1 that got you back in the stock market. You had an expanded range candle. You could have set your stop loss in the middle of this candle and got out. If not, your stop loss would have gotten hit based on this trading. Once you have a price flip, once you have a red 1, it's over. So based on weekly charts, you should either be out of the market or potentially went back in on a green 2 above a green 1, but now you're back to a price flip, so now you're back to neutral. So the weekly stock market right now is neutral, and but I'm still leaning bearish. Now, notice these arrows. These arrows have been here since the day I drew them. The beginning of the arrow is when I drew it. That's pretty damn good. I haven't looked at this in a long time. I probably haven't looked at this in months. And this arrow must have been here for a long time. Go back to my last Market Pulse video. I'm sure you'll see it exactly the same way. I haven't touched it. We're still grossly above the 50-week moving average, way above the 200-week moving average. Stock market's bullish. It's staying bullish. And finally, this is the daily. I should dump the moving averages. I do care about the moving averages. Actually, let's take a look at the volume on the daily chart. That's useless. Let me. Yeah, I don't really need volume on the stock markets. Indicators, favorites. Uncheck that, uncheck that, uncheck that. Blue, orange. There you go. All right. We bounced right off the 200-day moving average. Beautiful. I drew this arrow in real time. The last time I did this video was actually on this day. I drew this arrow in real time. I was looking for a rebound off the 9. Now, that's interesting. Where's my 9? Oh, I took it off. That's right. That's right. I set it to be how Wall Street sees it. This is how I like to look at it. Boom, there's my 9. Okay, that's why I use my version and not the Wall Street's version. $9.13 at the top. Gorgeous. Gorgeous. Wish I did a video that day, on this day. If I did a video on this day, I would have warned the world on this day, January 26th. It was obvious to me, you got to be cautious here. However, there's no reversal candle. So I would have warned everyone, but I would not have been in a rush. But look what happened the next day. This is known as a bearish harami. Not good. And then the following day, you get a price flip and it's all over. On January 30th, you need to know that you need to get the hell out of the market. And if that's not clear, the next day, a 2 is trading below the 1. Boom. Off of a 9 at the high on a 13 combo. You had a bearish harami. 3 days later, a red 2 trading below a red 1. The following day, the 3 trades slightly below the 2. The following day, the 4 gaps down, starts to trade down. You should not still be, if you're an active trader, no reason to be in this market by this time. But guess when you get back in, right off the 9, right off this 9. And if you're hesitant, you're going in a little late, still not a bad trade. We're still going up. But look, this 9, even though we are trading way above this 9 on the stock market, the stock market bottomed at like 2,500. You are on a 9 of the countdown. Even though prices are going up, you still have your countdown going. The countdown gets canceled if you get a full candle above the setup trend line, which currently sits at 28.55. Now, of course, the stock market went bullish based on this indicator alone. Right here, I would have been cautious because of the 50-day moving average, but it's kind of been useless this entire month, for the last month. However, once you got a price flip 2 days ago, on Thursday, you had a price flip back to a red 1. Red 2 did not trade below the red 1, but this morning, red 3 opened below and ticked down. That's when you could actually short the market right now. But I wouldn't. I'm still leaning bullish, but I would not be trading bullish based on daily timeframes here, okay? Because you're working on a red count to the downside, okay? Now, let's talk about some fundamentals of the stock market. Where do we begin? Let's begin here. The percent of stocks above the 50-day moving average. Look at the tech sector. The tech sector is absolutely crushing it. 81% of stocks in the technology sector are above the 50-day moving average. Only 3% of stocks in the energy sector are above the 50-day moving average. 3% of stocks above the 50-day moving average, okay? All the stocks are only 43% above the 50-day moving average, which is interesting because if you look at the S&P, the S&P 500 is below the 50-day moving average, right? So that makes sense. So more than half the market is below the 50-day moving average. But the tech sector is doing insanely well. Okay, where's that picture? Here we go. Okay, sector rotation, anyone? Check out my On the Record with Tyler Jenks of Lucid and the Hyperwave fame. He trades sector rotation. Check out that video. All right. I wonder if he's looking into this monster gap between tech and energy and how wildly different they are. All right. Next, what do we got? Oh, yeah. I forgot to mention this in the bond area. This is not good. Maybe Bitcoin had something to do with this. Net charge-off, the percent, what do we got? FT reports overdue U.S. credit card debt. Look at U.S. credit card debt that people aren't paying. Man, that's, now credit card is actually unsecured debt. Of all the debt that could, you see, this actually makes sense, right? Because if you default on your credit card debt, there's really not much they can do to you. If you default on your auto debt, they can take away your car. If you default on your home mortgage, they can take away your house. If you default on your student loan debt, well, they're just going to go after your parents or your children or your grandchildren. I mean, that's like, man, the Democrats really screwed that one up. Blame Clinton for that one. Just allowing the financial sector to go after you like it's bad. Like if you have a student loan, like you're in college and you happen to have an accident and you died, your parents will still owe that loan even though you're not alive anymore. Like, it's bad. Blame the Democrats. Go blame Clinton for this. He did that. All right, and this is why your college tuition is going through the roof, by the way, because nobody cares how much loans they give you, because they can go after your family and your co-signers and anyone for like the rest of your life. That's why they don't care. But yeah, interesting to see credit card at that high. All right, next, what do I have on this? Oh yeah, so I took this. I got this before the big down day. So before the big month. So the number of consecutive monthly returns without a loss. Okay, we were breaking the record set in like the 50s for the number of consecutive months without a loss. And that, of course, was broken. We had a loss last month, but that was an unprecedented streak. Close that. Almost done with these. Let's see. What do we got? What is this? S&P 500 breaks above the level it was at before February sell-off. Good. This was, I think we're back down below this level. And again, the technology sector is doing very well. The energy sector was taking a beating. So again, I was saving these things for like the last several weeks. No, we'll get. I forgot to talk about this. Damn it. We'll talk about it in a second. This I thought was awesome. Here's how your AI hedge funds did this month. Oh yeah, artificial intelligence is coming for our jobs real soon. Though I have to say that artificial intelligence hedge funds, they have done well over the last like 4 or 5 years until they got completely destroyed in the month of February, down 8% in 1 month. This is the average of hedge funds that are utilizing AI technology. Beautiful. I laughed when I saw that one, actually. All right, almost done with these. And then we'll get to gold and some of the other stuff. All right. I know it's a little slow. Look, we got a little out of hand. A little bit out of hand here. So this is a comparison between the 2015, 2018 market and 2011, 2014 market. I'm not usually a huge fan of these comparisons, but this one is pretty good, okay? Yeah, so here's Hurricane Donald gets elected. Here's Brexit. And it's funny, Hurricane Donald happened at the same time as Hurricane Sandy on the other chart. I remember Sandy. Oh, man. My uncle and my cousin both were in the flood zone. 8 feet of water in their houses. We had to completely destroy the first floor. I spent 2 weeks in the disaster zone in Staten Island. It was crazy. My apartment, this apartment that I'm sitting in, had no electricity for a week. I think this was before. This was before I was blogging. Before my channel. Anyway, very, very similar. But hey, that year it ended on a high. So we'll see what happens. I thought this was a very interesting comparison between the two. All right, next. Almost done, 4 left. Okay, so this is another last one for the stock market. So Apple took a beating. Maybe we'll take a look at Apple chart later. So Apple decided to do their own displays, and the market doesn't like it. I guess the market liked it when they outsourced Apple, when Apple was outsourcing the physical building of their cell phone screens. Now that Apple is actually doing it themselves, not looking as hot. All right. So these two I totally forgot about. So I found this interesting. Now, this was very interesting, actually. So I ran across this. The blue is the US dollar. The orange is the LIBOR versus OIS spread. Now, I had to look up what that is. I mean, LIBOR is London Interbank Offer Rate. It's supposed to be the risk-free rate, but it's not really the risk-free rate because there's bank risk. So then there is the OIS spread, which is supposed to show you a different type of risk-free rate, and this is one over the other as a spread. And I had to go and look this up, and here's where it comes from, sort of. Okay. So here's a good article. I should probably throw that into the description of the video. It was a Bloomberg article where a lot of this stuff came from. So this is new. All of a sudden, like all these articles are coming out about the OIS spread. Jesus Christ. Like I said, I had to look it up. I haven't heard that word in a long time. Okay. And it came from this. So someone tweeted this chart. And I found this really interesting at first. Oh, no, we'll get to that in a minute. And I'm like, oh, wow. So the dollar has really been following this thing. And look how it's because this thing goes out into the future because it's because you can buy this into the future. And wow, look at the spread going up and look how correlated the dollar is. Except when another analyst looked at this and he said, nope, not exactly. Because here's the same exact chart, but taken back 3 or 4 years. And all of a sudden, your dollar correlation with this thing is totally gone. So you got to be real careful, okay? This is the kind of thing that Zero Hedge does. Though, see, I thought this was a good correlation because at least it went all the way back to 2016, to like almost to the beginning, almost like it went back to Q2 of 2016. So at least this went back 2 years. Zero Hedge goes back like 4 days, and then they're like, look at this amazing correlation and look at how it's breaking. At least this went back 2 years. But hey, you go back 2 more years or 4 more years, actually. You go back 6 years, and there's absolutely no correlation between the dollar and this thing. So it's great that someone on Twitter pointed this out in a reply saying different time frame, same instruments, zero correlation. So that was actually nice to see. Okay, so good that some analysts are checking other analysts. I actually leave these. Maybe I'll throw those into the video description. Okay, that's it with the stock market. I'm going to close these. I'm going to save these. I'm going to close them. Maybe I should take a break and do some QA and then get back to, maybe I'll do it after gold. How about that? All right, what is this? Gold. Man, haven't looked at these in so long. They'll be shorter if I actually start doing this thing regularly again. This is monthly gold. Let's zoom out. I think this line is coming from the weekly chart. Yep, I got my new code. Let me get my single moving average. Yeah, it takes a minute. It's okay though. But now they're going to be all set for next time. So here's the 50. Where the hell's the 200? Oh, wow, way below. This is monthly gold. Let's see what we got. Oh, wow, monthly gold tops on a 9. Beautiful. Absolutely beautiful. Forgot about that. Yeah, I'm not sure I really want the RSI and the MACD here. Anyway, monthly gold topped on a 9. Also, the secondary top came on an aggressive 13. That's nice. Now notice there's no other arrows between the two tops. The September 2011 top monthly comes at a 9. The next high in this mess on closing basis, I guess there was a slightly higher high, but that's like 2 months after the 9. The next high comes in October 2012, and that tops on an aggressive 13. Now we do get a bottom at a 9 in 2013, August, and then we kick off the countdown. Now the countdown never actually completed. Damn it, it missed it by one candle. One candle. Damn. Man, the countdown made it to a 12, but it did give you an aggressive. Later on, almost made it, but it bottomed on a 9 because, again, this is my addition to the code where you have this green arrow on a 1 candle in January of 2016 because this was a 9 and when the candle started, and they perfected 9 no less when the candle started, and therefore that arrow is there even though the price flipped. And look where it topped on a monthly scale. It topped on a 9. Well, one candle off, but it topped on a 9. I'm not sure why there's an intersection here. I didn't think there would be. I might have to check on that. The good news is, if there is a bug in this code, which I don't think there is, we tested this thing to shreds. I can always update the code and no one notices, at least the clients that have access to it. And now we've kicked off the countdown, and even though we're trading lower than where the 9 was, we're still working on a countdown to 13. But look, the price is flipping, and therefore gold is totally neutral. Now it's nice that we're back above the 50-month moving average, but until gold gets back to 1400, I'm not really all that crazy about it. So that was gold monthly. Let's look at, what is this? This is gold weekly. Let me zoom out. On a longer term scale. Again, let me close this, close this, close that, close that. Oh man, I got them backwards. I want to do it the other way. Uncheck 20, uncheck 100, blue. There you go. So, see what we got. I'm just going to zoom in. You are, wow, that's a lot of pluses. The pluses are the deferred 13. And Jesus, how far back do they go? Oh my goodness. Oh, this thing is going to be deferred for a while. Wow. So we have to close above 13. We got to close like above 1360. Look at this thing has been deferred for a year. Wow. Like the deferred 13 is still going. There's been like other bullish nines inside. There's been like 2 other bullish nines inside this deferred 13. Wow. That means that the code is functioning real well. That's impressive. So anyway, those that understand this indicator know why I'm impressed right here. Man, I would have thought we got it here. Almost. Damn. Close. Shoot. It's in the middle of nowhere, guys. I would hold off on gold. I would not. It's totally neutral to me right now. There was a possible trade down here off of this back test of the trend line back in December, but it's not looking too hot. Not looking too hot. Jeez, I have a lot of questions. All right, after gold, I'm going to take some questions. And finally, daily gold. Oh, I do have silver, actually. Yeah, see, like with gold, I don't want to talk about gold too much because like from a technical, from a TA perspective, it's in the middle of no. Gold has done nothing for 2 years. 2 years, it has done nothing. Like, geez, there were buying and selling opportunities, but right now you're just smack in the middle of a high and a low. So it has a double top, which means it can go up, but so I'm like leaning bullish on gold, but there's no obvious trade right now. So I would wait, and I'm going to try and do these more often. So when there is a bullish trade, I will I'll let you know, but like I don't see anything. All right. Daily. Again, let me clean this up here. Let's clean this up. Indicators, favorites. Set my 50, set my 200. Let's make the line sticker. Again, daily is also in the middle of nowhere. Look, there hasn't been a single 9. It topped on a traditional 13. That was nice. It gave you a 9 here. So, oh wait, it would have given you a 9 here. That's why there's no additional 13 being kicked off. Like there's no 13 countdown. There is nothing really. Yeah, I mean, this 9 kicked off at 13, which has completed. It called the top and it's over. And now we're in the middle of nowhere. Price is flipping. There's no trade here. Maybe a red 2 below a red 1, but it's too choppy. Like, look, gold is nowhere on all metrics. All metrics. So, silver, I haven't looked at silver in ages. Here's monthly silver. Oh, wow, look at that. 913.9 bottom. Oh, let me use the good code. Silver I haven't done in a long time. A long time. Last time I did silver, it must have been this arrow. Must have been in June of last year. Yeah, silver looks bad. Gold looks better than silver. But let's see. Let me throw my indicators up. After silver, I'll do questions, I promise. It's gonna be a long video, guys. I really should go to bed. I think I was supposed to have a meeting tonight that clearly probably won't happen. And tomorrow I'm off to Russia, so I have no idea how many of these videos I'm going to be doing in the near future. Why is this thing still here? All right, take that off, take that off. Make that bigger. Blue and orange. Okay, so what do we got on silver? Did silver top on a 9? Damn, it didn't. Shoot. Gold did, silver didn't. Missed it by a little. This came on a 9 here. Oh, that was the low. That was off the low. But yeah, this is nice. Monthly candles, guys. 13.9 buy. Didn't make it to a 9. And now we're in this triangle. I drew this triangle months ago, probably been 6 months. Still looks good to me. I'm actually gonna I mean, it's always a best fit kind of thing. I mean, nothing's changed, right? I needed silver to get above 20 bucks in order to project it up to back to 30. And on a monthly chart, I mean, this thing is nasty looking. My projection for silver has always been down to the $10 range. And I'm still seeing that. Remember, double bottom. I mean, this might be one of my exceptions for a double bottom in that it takes a long time between double bottoms, but it's not that long. I would need another year or so, or maybe even 2 more years. If we go back to 13 bucks in silver, we're going down to 10 and probably lower. I'm still kind of, I mean, gold is starting to show bullish signs, but not silver. Silver looks bad. And again, silver has done nothing for years. Years. Why do people care? I don't get it. I don't get it. Whether you're a holder or a trader, it's done nothing. Here's the weekly chart. I'm not going to bore you by, I'm just going to drop all my indicators because they're not going to do anything anyway. It's the same triangle, really. I'm not sure what this line does. I'm going to delete that. And these triangles, don't mess with these triangles, guys. Should probably maybe lower it a bit. Don't mess with these triangles. I mean, they're telling you, lower this too. I'm going to slide this over. The projection hasn't changed. Time has. There's your target, down to the $10 area. 30% fall from the bottom of the triangle. Still forming. Daily silver. Again, nothing. If you use the indicator, you'd be short. I'm going to close all of these as well. Next time I'll add them. I should also switch this chart to be the commodity and not the TVC. All right, let's take some QA. Oh no, one last thing. The gold silver ratio. So this thing actually kind of failed, right? Because the gold silver ratio, I used to talk about this more often, looked really good, right? Like whenever you cross the 80%, the 80% barrier, right? Like 80 to 1, like the price of gold is 80 times more valuable than the price of silver. Silver tends to go up relative to gold. And whenever gold is only 50 or 40 times more valuable than silver, silver tends to outperform gold. And we hit that barrier in 2016. And I talked about us hitting this barrier back then. And I'm like, oh, wow, this should completely reverse. Gold should now fall way more than silver. And silver can go up a little bit and gold can probably fall. So it's a good spread trade. But as you can see, it went back up. So right now, once again, gold is grossly overvalued compared to silver. So either silver needs to go up and catch up to gold, or gold needs to start to go down really, really quick to catch up to silver, because whenever this ratio hits 80 times, not many good things happen in the gold to silver ratio. All right. Let's take some Q&A. I was gonna do oil and euro and maybe pound and what else did I have? No, that's the pound. That's the pound. That's my indicator. But I'm kind of tired already, man. All right, let's take some questions. What is your fundamental belief on dollar cost averaging as an investment strategy? I'm not a big fan of dollar cost averaging. Now, you dollar cost average when you, so your financial situation, all right, I'll throw the chart of Bitcoin just because I'm curious. All right, what is this? This is the 4 hours about to go on a 9. All right, let's look at the daily. There we go. I'm not going to talk about Bitcoin, but I'll have it up as a background because the markets are closed. It's the middle of the night. Okay, so I'm not a big fan of dollar cost averaging. Your income should let you dollar cost average, right? So when I was buying gold and silver, I was dollar cost averaging into gold and silver, and not because I wanted to, but because I only wanted to spend X amount of my income every month on gold and silver. This is back in my dumb days of being a gold bug and pre-Bitcoin, of course. So you dollar cost average into your 401k because you have a job, so you have money, so you dollar cost average. As far as trading goes, you don't need to dollar cost average into a trade unless you're not 100% certain on the trade, right? Like with some trades, you have more ducks lined up in a row than in others. And the more confident you are in the trade, sorry. Man, I forget I'm always on camera now because I'm on Zoom. I can't like yawn or something or sneeze or whatever. You guys see everything. So anyway, maybe we'll save this for another day. I'm a fan of dollar cost averaging when you're like, it's a long-term investment and you're just putting a certain percentage of your income into something. But as far as a trade goes, no. Like I mean, I don't dollar cost average into my options trade, but I don't go all in at once for liquidity purposes because I don't want to spook the market. So, and it's not even that I have a lot of money, it's just that I trade something very illiquid, and I don't want the market makers to know what I'm doing. So I kind of spread it out. But that's more for strategic reasons, not for dollar cost average reasons. All right, next. Okay, let me get the tipped questions first. I'm sure those guys have been waiting for a while. what do you think about adding a probability percent to your 9 count arrows so we can see how strong or weak the indicator shows? I don't understand what you mean by that. I mean, you already have a perfected 9 and a non-perfected 9. So read up on the difference. You already have the intersection indication. So read up on the difference. And what makes my conviction of a 9 strong or not is what else is happening. Is there a reversal candle? Is there a chart pattern I can utilize? Is there a trend line? Is the setup trend line involved? Is there a moving average? Like, what else is happening at that 9? And that would give me a percent as to what kind of a 9 that is. So I can't code all that in. I probably could, but maybe one day as the code advances, but not anytime soon. All right, let's go back to the top of the questions. How do you use open interest in the options market to analyze potential trading opportunities? I prefer to trade options that have the greatest amount of open interest. Oh man, I really hope one of my friends is not watching this right now because my phone's about to ring with him cursing me out for for giving away, you know, our trade secrets. So I prefer to trade options with the highest open interest because that has the most liquidity and that has the least bid-ask spread. So I have the most liquidity to get in. I have the most liquidity to get out. I can get the best price. The higher the open interest, right? The higher the open interest usually happens on strikes with the most round numbers. So for example, an Amazon strike of 1,500 will have the highest open interest versus, say, 1,480, usually. Same thing with dates. Like the third week of the month option will always have more liquidity than the month-end option because just option traders like the third week of the month. Always been that way. The end of month options are new. So anyway, so another thing is you don't want to be holding too much open interest. Like if there's only 1,000 options outstanding for a certain set of combination of strike and expiration, and you're holding 500 of those 1,000, you got a problem, right? You are holding all the liquidity. You have to sell. Who the hell are you going to sell to, right? So that's how I utilize it. I make sure that I'm not the dominant, and I have been. Like, trust me, me and my friend, he was sitting in the back in my New York seminar. We've had situations where me and him had like 40% of all the option interest in a trade on a particular combination of strike and expiration. And that was making us nervous. We're like, shit, you know, like when we sell, we're going to get screwed. Because if no one's buying and we want to exit, now what? Even if we're making a profit, we're going to have to lose a lot of that profit because like people may not want to buy it from us, right? They're going to lowball us. We might have to sell below the intrinsic value. We might have to execute the option, but we can't really execute the option because we don't have enough, you know, capital to buy up, you know, 10,000 shares of stock. If it's like, let's say $100 stock, we don't have that kind of money. Yeah, so you don't want to get screwed. All right, next. Any thoughts on large IPOs happening in the market? I haven't been paying attention, unfortunately. Does this signal a top? No, I don't think so. It's been a useful indicator in the past. I don't know about that. I'd have to look that up. You stumped me on that one. I'm not really big in the IPO markets. I usually wait for a stock that goes IPO to lose 50% of its value, like Facebook, before I recommend it. No thoughts on China oil futures. I don't think I'm going to look at that tonight. I'm way too tired. Next. Can you talk a little bit about the emotional aspect of trading or the role emotions play in trading? Oh, God. I can talk all day about that. That's your number one nemesis. Your number one nemesis in trading is emotions. Man, I will say the better poker player you are, the better trader you should be. If you're a terrible poker player, trading is probably not what you should be doing. Emotions really get involved. Really get involved. I'll talk about that a different day. This video will last forever. I also have to think about like what I'm going to say because there's so much to say. I'm going to make a series of educational videos. It's going to go to a paid subscription site that I'm going to be working with. I'll figure something out. Maybe I'll have like one-off videos for like some Bitcoin price. And I'm going to make a list of all of how emotion plays. It's a good topic. Very important too. Next. Tone, does the national debt have any correlation with traditional markets? No. Does the national debt concern you? No, it does not. The national debt is generally irrelevant. Generally, not always, generally irrelevant. I'll tell you what does concern me. Was it national debt clock? Yeah, there it is. There it is. U.S. national debt. I don't know how accurate this is, but it's really cool looking. U.S. national debt is at 21 trillion. Who cares? Who cares? You know what concerns me? Where is it? This concerns me a lot. U.S. unfunded liabilities, 112 trillion. I think this is grossly inaccurate. I think this is upwards of 150, but hey, I'm not the one making the statistics. This concerns me. This concerns me. This is what you should be worried about. Not the number at the top. This number. This number. Here's the difference. Who do we owe this to? Who do we owe it to? China is not really buying our bonds much, right? Who cares? Who's going to come and collect? Who's going to come on U.S. soil and collect the 21 trillion that we owe them? And the government is doing their best to devalue the currency. They can't do it, but they're trying. They're printing as much money as they humanly can to devalue this thing, and they can't do it. They can't do it. They're trying. Nobody cares. They'll just print more money. Okay? You know why this is a problem? You know why this is a big problem? Okay, for the audio podcast that, oh God, they're going to be listening to it. The problem is U.S. unfunded liabilities. Because the difference is that you owe U.S. unfunded liabilities to the people inside the borders of this country. This is owed to whatever, the Federal Reserve, the people outside the country. You can just tell them to go screw themselves. We have all the guns anyway. The problem is that this U.S. unfunded liabilities, that's like 6 times bigger than national debt. We owe this to the people already inside our country, and they're the ones with the guns. That's the problem. That's the problem. Now, guns aren't the problem. The fact that we owe them money is the problem. And these people are going to want to collect. And guess what? They don't have to come and attack the country. They're already here. These are all of your government employees. Okay? Superpowers usually, collapse from within. And what collapses superpowers, like Rome, is unfunded liabilities. This is when politicians promise you healthcare benefits and retirement benefits and social security benefits and all other possible benefits and your salaries and all this other nonsense, but the government doesn't make anything. So when these promises cannot be met, a lot of bad things happen inside the borders of your own country. This is how riots start, and it just gets bad. It's how governments shut down. Nothing gets the worst thing about the government shutdown was the fact that you couldn't get your passport. So maybe passport creation should definitely be privatized. So at least you can still get your passport in the government when the government shuts down. And it's worse when the government shuts down, right? Because the government shuts down, they all go on vacation for 2 weeks. They don't get paid for those 2 weeks, but then they get paid on the back end of that. So what the hell? I just gave them. I just paid for their 2 week vacation. Anyway, that's the unfunded liabilities is the problem. Worry about the unfunded liabilities. Don't worry about the national debt. Nobody cares. At least I don't care. You can care. I don't care. Next. Yeah, actually, if the national debt gets kind of high, it's not bad for the market, because if the people start distrusting the government because of the high national debt, they're going to buy Apple stock, because Apple could always leave the US and incorporate somewhere else, right? So your money is safer in Apple stock than it is in government bonds. So I don't see it as all that bad for the stock market. All right, next. Good question. Tone, I know you like to buy rising markets, but do you ever scan for oversold stocks and play the bounce? Well, I don't scan for it, but when they come across my radar, why is my computer not charging? Oh, because it got disconnected. Give me a sec. Okay, so I did not get to the currencies, so I'm not going to do them. So the last time I did this video, last couple of times I talked about a couple of stocks. I think one of them was XON. Let's look at the last time I looked at XON. It was January 14th. And I know I talked about it for like 3 weeks in a row. So let's take a look at XON. I certainly don't want to give you guys, advice on a stock. I'm going to dump all of these and I'm going to reset them. Indicators, favorites. Moving averages. Let's fix the moving averages. Make them simple. Okay. So January 14th is the last time I looked at it, but I talked about it for definitely 1 week earlier, maybe 2 weeks earlier. And I specifically talked about it coming off on 9/13. This was actually a 13 in the beginning of this candle. It just didn't finish that way, I believe. I believe this was a 13 at one point. And this is the stock. This is the kind of low you want, okay? Especially when there are some fundamentals behind this stock, okay? So you can check out the fundamentals. But this is what you want to see, right? You had a couple of 9s at the low, right? You had a 9 at the low here, didn't really go anywhere. Then you had a 9 at the low there, okay? And then it went up, went flat for a while, and now finally starting to go up again. So sure. And off of this last 9 that I talked about almost in real time when I was doing traditional markets, it has rallied. This stock has rallied about 50% since then. So not a bad return, okay? So definitely go back to my last videos of Market Pulse. I'm going to make a playlist. I'm going to make another playlist on my YouTube channel for Market Pulse. Okay. So that was one. I think there was another one. What was it? AGN? Was it AGN? Yeah, Jan 23rd was last time I looked at AGN. Let me see that one. Oh, and by the way, for educational purposes only, the code itself gave you a potential stop loss with this line known as the risk line. Okay, so if you're going long off the 9, that's your stop loss. And you could wait for the 2 to trade above the 1, but you can take a stab at this earlier because you know where your stop loss is right there, which is very reasonable. So the stock at the 9, the following candle made the low, was about $11.20. The stock is XON. And it currently trades at 17 bucks. And look, it's on a 7 of 9, stuck under the 200-day moving average. So it's probably a little too late to jump into this. It will probably correct a little bit. And it's done really well during this market, catastrophe over the last month or so. It's done really well. All right, AGN. Let's look at this. Daily chart of AGN didn't do as well. So that means I would have looked at AGN off of this 13. And because I was looking at it in early January, I would have been looking at it off the 13. And as you can see, this was also, the stock went from 160 bucks. It pretty much made the low at 163 off the 13. And Wall Street loves the 13s. And you can see we made a 9 at 180. Not as good of a return as XON, but it continued going up. And you can see that at the 9, the last time I did this, it was probably around here. I drew these arrows. I was looking for a short pullback to the 50-day moving average and then go higher to 190. I hit that one perfectly. I didn't even know. Last time I looked at this chart, you saw by the timestamp was like the 26th was in this area. This was never a 9, or my code would have. Oh, wait, I'm using the old code. Hold on. Let me grab the new code. This stock, it's AGN, currently trading at 166. Favorites. Oh, no, wait. I was going to put them in reverse. Let me close that. Shoot. Indicator. Apply defaults. Blue, orange, make them thicker. Oh man, this wasn't a 9. That sucks. I was hoping it was a 9. It never traded above the 5. So it price flipped at the top. Never gave you a 9. But then it started to go down, gave you a 9 here. It was working on a countdown. This would have been hard for me to time. I would have missed it, right? But look what's going on right now. Look at this. Okay, so I probably, if I saw this red 9 coming, with this red 9 bouncing under the 50-day moving average back on the 7th of February, I would have seen this 9 as probably a continuation 9, and I would have been waiting for the 13. What is this D? What does that mean? Oh, dividend. Okay, makes sense. Haven't looked at stocks on this thing almost ever. And I would have been waiting for the 13, which didn't come, so I would have been stopped out. There could have been a bullish trade here, but you see how you have a 9 at the 50-day moving average rejection. So right now, I would look for a 1 to 4 day correction and then reevaluate to try and figure out, are we gonna reverse all the way back down, or, all right, what's going on? Or are we gonna go higher? Okay, so this is what I'm looking at right here, right? So I would look for the correction of over the next 3 to 4 days, and then reevaluate. So maybe we'll get back to this guy. Okay, so yeah, so I don't just scan for things at the low. I need something at the low to actually trade. I also want to take a look at Apple. I know they took a hit. I should have Apple in here. And I do. Okay, where the hell is it? There it is. Hasn't done that bad. Apple is like at all-time high. I don't know what the hell people have their panties up in the bunch for. Looks fine to me. I'm not even going to bother putting my indicator up. It's bearish though, right? You have a red 3 trading below a red 2 traded below a red 1. It's overall bearish, but I'm not going to put the indicator up. Oh, here's another thing I wanted to look at. This guy. MSCI's momentum indicator. I had a client call and we talked about this. So you can see from early, I'm not going to cherry pick. I'm just going to go to January of 2017. So as of January 2017, not January, sorry. Yeah, as of January 2017, the MSCI momentum indicator has outperformed the S&P 500 by a lot. It has doubled it. Now, this is why I like to buy breakouts and breakdowns instead of the dips. I only buy the dips when there are perfect reasons to buy the dip. But this indicator shows you how much more lucrative it is to buy things that are going up and sell things that are going down than the other way around, than trying to time the tops and time the bottoms. So the momentum index takes stocks that are doing well and puts them in, and it removes stocks that are doing poorly. So it literally picks the best performing high-end stocks, and which is probably the tech sector right now, because 80% of it is above the 50-day moving average. So most of it is probably tech, and very little of it is energy stocks, because only 3% of those are above the 50-day moving average. And you can see how this index has crushed the S&P 500 in the last 15 months, has doubled the return of the S&P 500 in the last 15 months. All right, next question. Can you give an example of the type of analysis you provide for your previous employers on Wall Street? Is it at all helpful for you today? No, absolutely not. I didn't provide any analysis. Man, am I even allowed to show that? I was a risk analyst. We were building risk models. Like I didn't do any. Not only were we building risk models, like I wasn't like good enough to actually build the risk models. Right? I wasn't smart enough to build the risk models. My master's in financial engineering was not going to cut it. I either needed to be a developer or a quant. So I either needed to get a PhD in that shit, or I had to be an expert programmer, and I was not either. I was responsible for data feeds into the risk models. So which is a very lucrative, high-paying job. I was making, when I quit, I was making 150K or something. And I mean, my job had a lot of facets. I was also the intermediary between CFAs and financial analysts and internal developers. All of the internal, modeling questions came through me. Any kind of hey, how come the risk of this portfolio doesn't make sense? That all of that went through me. I had to understand the code. I had to understand the models. I didn't actually analyze any companies at all. Completely unrelated. No trading involved. Those were all my interests. That wasn't actually my job. My job was very different. Like I said, we were building. I was also responsible for stress testing. Let me see here. Hold on. Documents, stocks. Huh. Hey, where is it? Oh man, did I move it recently? Hold on 1 second, guys. Where'd it go? Shoot. The hell could I have done to it? Oh man. I just ran across it the other day. Oh well. I had like all my research that I did for stress testing. I had to pick out like significant periods in the history of global markets and then pick out those time periods for stress testing an equity portfolio. Like, how would a current equity portfolio do if let's say the dot-com bubble happened again? So you take all of the global trends that took place during time X and time Y, and then you apply that same environment to the current portfolio, and you can stress test the portfolio. So I was responsible for all that research and then properly select the time periods and analyze those stress tests of portfolios. So things like that I used to do. All right, anyway, it's getting boring. I'm boring you guys. It wasn't a very fun job at all. And I did this at like 4 different companies. For those of us that can't babysit trades all day, can you recommend a strategy or time frame to use for swing trading? Sure. You can still use daily charts, set your stop losses, and make sure your daily trades are within weekly trends. So if your weekly has gone bullish, then you enter your trade on a daily level. If your weekly is neutral, don't touch it. So right now, don't touch it. If you can't babysit your trade, you shouldn't be trading Bitcoin right now. Actually, stock market also, right? From what I talked about earlier, your weekly has to be in bullish, and your daily has to be bullish inside of it, and the daily can be at the end of its potential bullish run. Next. What are your thoughts on real GDP growth being negative for years? How can stock market continue to rise when real growth is below zero? I don't trust the metric. I think it's all conspiracy, gloom and doomers, that real growth is below zero. I don't see real growth below zero. All I see is I want to go to dinner on a Friday night and I can't find a freaking restaurant that has an empty seat. Now I understand I showed you all the credit card debt from earlier, but that's not all true, right? Real growth looks pretty damn good to me. Wait till robots take over all the jobs, right? I mean, real growth is going to be like -20 when the number one profession in America, and pretty much every country, not every country, some countries have farming probably is still one of the top professions, but in America, the highest profession with the number one profession is driving. When driving cars come, all of those people go unemployed. And the gloom and doomers will show you how real GDP growth of an economy that has just replaced its number one profession by self-driving cars is -1,000. But in reality, the growth is huge because it just created so much productivity and so much health in the economy. There will be less traffic, there'll be less fatalities, there'll be less healthcare costs. So many things become cheaper and more efficient, but it will not be justified by the metric of real GDP growth because it'll look like everyone's unemployed. Like, there's got to be better ways to do statistics. So I'm not going to get too far into it. All right, next. NASDAQ finished quite low today. Tech stocks are currently sinking. Facebook taking a beating. What else is going on? The tech, it's just one day, guys. It's one day. Let me look at Facebook. I already showed you Apple. Everyone was telling me how Apple was taking a beating. I mean, here's Apple. I mean, come on. Really? Really? It just hit an all-time high like 5 days ago. Not 5 years ago, 5 days ago. We hit an all-time high. So it had a bad day. People are worried that Apple can't make their own screens. Let's look at Facebook. Last time I looked at Facebook, January 14. I think I also talked about Facebook. I think Facebook was also like on a 9 or a 13 low. Let's find out. January 14th, last time I looked at Facebook. Why did I do that? I don't see anything useful. Yeah, Facebook took a hit today. A little more than usual. Let me get the latest code up. Get the moving averages in here. All right. Here's the latest code. Well, if you use this code to trade, you see how Facebook has been flipping colors for the prior 4 days? You should not have been in this trade. If you're a day trader, it has fallen to its 200-day moving average. It gave you a higher intraday low, but a lower daily close. This is not a good sign for Facebook. And however, I would need to see another candle open and close below the 200-day moving average, while giving me a lower low that allows me to say that this indicator gave you a red 2 below a red 1 for a potential short play. Facebook has not done much in the last year. Yeah, it's pretty flat for a year. is below the 50-day moving average. So Facebook is having some issues. I don't know. Maybe they should bring scam ads back with ICOs. I mean, they're going to have to, right? I mean, check this out, right? Check this out. If Facebook stock starts to fall a lot and all of these ICOs are printing money, Facebook ain't going to sit on its high horse. They're going to bring back scams. They're going to bring back the Ponzi's because they want that ad revenue. They're just going to charge them double. Just going to charge them double. Hey, ICO, you guys want to advertise on Facebook? Pay 2x. It'll be like Uber. During times of stress, pay 2x. And you know what? These ICOs are going to pay 2x because they're printing their own money and they want to sell you that money. So yeah. So if Facebook stock falls too much, you're going to see if Facebook stock falls while, Twitter stock is always a basket case. But if Facebook stock falls too much, they're going to want to compete. And they might bring back ICO and BitConnect ads because they can make money from that. All right, next, what do we got? Topix. Wow, haven't heard that in a while. Topix gained as yen dropped following the Fed hike bet a couple of weeks back. If Fed hikes them more aggressively than inflation pressure, would you expect a different reaction? Let me take a look at Topix. I don't have a chart of Topix. Make a copy. Topix. Man, is this video 3 hours yet? Topix. The whole thing or the 100? I'm going to go for the 100. I like the leaders, guys. I like the leaders. Oh, man. Are they not going to give me the data? Exchange agreement. I don't want to give them my personal info. I sure as hell ain't going to do it right here on live camera. It's late. I haven't been drinking, so there's no way I'm this dumb. Oh, wait, what happened to my... Let's do this again. All right, so you're giving me the data, so what's the problem? Oh, no, you're not. You give me Apple. Shit. Oh, come on. Yeah, that's a decent fall. Yeah, it's also not good. You see this triple bottom right here? Man, Japan's in trouble. I honestly don't think it's all. Actually, no. It makes sense. You know why? Here's why it makes sense. Here's why it makes sense, right? You have to go back a few years. Yeah, you have to go back a few years. I want to say 2015. China sells U.S. bonds. Japan. Now, the Japanese had started. Oh no, this is 2018 article. Yeah, this was around 2015. See, this is 2017. That's too late. 2015. There, right there. 20. What year is this? This is the problem. This is why Japan's screwed. I knew this. It's been a while. Now, this had started way before 2016. This started in like 2015. And China was selling US bonds at the high. China was smart. We talked about bonds earlier in the show. China started selling US bonds when the rate was at the low. So the US government bonds were at its peak in price. And but Japan started buying US bonds at the worst possible time. And you can see that in 2016, in December, Japan tops China as the #1 holder of US bonds, right? Because China was out. And Japan got stuck holding the bag. So now, when I go back to my bond yields, or just my 10-year bonds, right? The 10-year US Treasury bonds, where's that article from? That article is from December 2016. Nope, not there. I don't have that many tabs open. It's only 50. Kidding, guys. Oh, this is the monthly chart, right? So December, here, right? So this is December of 2016, right? But by the time the article has come out, I'm sure it happened right here. Like, because I remember these things going back to 2015, where Japan is buying all of the government bonds, but China is selling. So Japan gets caught holding these government bonds at a high price. And now these bonds are going down in value. So Japanese government's like screwed. And people aren't having a lot of faith in the Japanese economy. Also, you don't know if a lot of private companies in Japan ended up buying government bonds. So maybe that's what's causing the stock market to go down, right? Because, or the Japanese might entrust in their government a little more than, or the Japanese investors a little more than the, US traders. But yeah, this is your problem. So this is why the Japanese, because of, go back to this headline, this is why the Japanese are in a little bit of trouble because they started buying up government bonds and now they're losing money on those deals. All right, next. Is it bad that the FANG plus Apple is 25% of the NASDAQ? Well, the FANG has Apple in it. The A in FANG is Apple. So it's not FANG plus Apple, it's FANG. FANG plus Apple is counting Apple twice. Is it bad? Not really. I mean, they're the leaders, right? Again, I like leaders. I like the NASDAQ 100 better than the NASDAQ. I like the NASDAQ 50 better than NASDAQ 100, and FANG is NASDAQ 4. It's the biggest 4. In case people don't know what FANG is, it stands for Facebook, Apple, Netflix, and Google. People like to throw Tesla in there as well. But that's the FANG. No, I don't have a problem with it. Well, the NASDAQ is tech, right? I mean, NASDAQ is mostly tech anyway. So like the NASDAQ can't be overweight tech. NASDAQ is tech. Was it easier to profit when trading was done in open outcry pits and not electronically? It was easier to profit for specialized market makers, which no longer really exist. It's all bots now. For an average trader, he wouldn't be in the pits. No, not at all. But I wouldn't know. I was never in the pits. I like trading from the comfort of my own home. Next. This is going to get me in so much trouble tomorrow. Tone, my wife is a bad investment. I'm losing tons of money. How can I hedge? Haha. Oh man, Bitcoin. Don't tell her. Buy some Bitcoin and hide it. There's your hedge. All right, guys. I didn't get to the euro or the British pound. I didn't get to the currencies. I'm tired. Let's call this a night. Closed out with 600 viewers. You hung in there, guys. You hung in there for the traditional markets. I'll toss you a bone and talk Bitcoin. Coming up on a 9 on the 4-hour in 20 minutes. We're above the 50 period moving average, which was never relevant on the 4-hour. You still have a target from the bullish pennant, which is around 9,000. I don't think it's going to get there that quick. The daily chart, I'm still like, to me, this is still a dead cat bounce at best into the trend line at the top, most likely into the def cross in about 3 days, and possibly it will not even make it that high up. I think this was just a short squeeze to, wreck those that were short. But I still think traders should be timing shorting opportunities here and not trying to go long, because I don't really see much that gives me confidence that we're ready for new all-time highs. I don't know what Ven Zen's take on this is. I have not spoken to him in a while. Sorry, I'm busy. If he tweeted something out, you tell me. All right, guys, if you like my work and you want to support my work so I can bring you more videos, please check out the affiliate and referral section of my website. Lots of things here. And as far as I know, none of them are Ponzi's. They are real companies. And by using these links, none of them are MLMs. And you either save money or you can support my work by using these companies, and it's not going to cost you anything extra. All right. Calling it a night, guys. Good luck trading, and I'll see you all bright and early with Leah tomorrow morning. Bye, guys. All right, stop sharing.